Welcome back. We're continuing our coverage on what this budget, of course, means for stocks and the market as a whole. And now we have with us Gautam Duggad, Head of Research at Motilal Oswal Financial Services. Gautam, good morning. Great to have you on. So you've had a Sunday to now go over the details and, get down to the stock level reaction. And we were just looking at some of the, the top picks in the portfolio. Obviously, lots of consumer names out there. We'll put that up in just a minute. There's Trent, there's Titan, which has been one of your long-standing favorites. There is M&M, Maruti. So just run us through the thought process. What is the allocation shift in favor of consumers?
Good morning, Subhi. Thanks for having me. So yes, on balance, I think it was a pretty decent budget print. Numbers are quite believable as they've been for last 4-5 years for this government's budgets. Second, without impacting the fiscal consolidation territory, they've shifted the scales away from consumption, capex towards consumption. If you look at the percentage numbers between FY21 to 24, the capex compounding was 31% in terms of allocation, but the next 2 years now is about 9%. As far as the actionable portfolio-related changes are concerned, I think there is going to be a imminent shift from consumption to capex. Reverse capex consumption. Yeah. Now, what has happened is if you look at the portfolios of the top domestic funds, which are public, you would notice that most of the top 20-25 mutual funds in India, as of their last disclosed portfolio, are overweight on industrials. And almost 80% of the domestic institutions are underweight on consumption. So there is definitely going to be some realignment which will happen. Of course, people will not immediately move from underweight to overweight, but more closer towards equal weight and slight reduction or trimming in the capex portfolio. Second, generally what market does is the multiples change first and numbers follow later. So capex multiples have already corrected. If you look at the last 3 months of the capex stocks behavior, even big names are down 30-40% now. So large part of multiple contraction is already underway. Some more can happen. And then numbers actually will continue to remain strong. This quarter has been very strong for capital good companies in terms of earnings growth. Maybe it will continue for a quarter or two. But what market will start factoring in is the reduction in the order book growth, say in the second half onwards for FY26. And that's why you will see multiple contraction happening ahead of that. And I think the exact reverse can happen in consumption names. The consumer companies' numbers have been absolutely weak. This quarter, there is actually a decline in earnings for consumer companies. Very rarely you see consumer companies post a cumulative earnings decline. So that is happening right now in third quarter. I think the earnings can continue to remain weak for a quarter or two. But the multiples have been derated over the last 3-4 years for staple names, basically, not for discretionary names. Now that reversal can happen, and numbers, again, as I said, for capex can follow after 2 quarters in terms of moderation. For consumption, it can accelerate after 2-3 quarters. But typically in consumer staple companies, you see growth averaging somewhere close to 10-15%. Volume growth is a more important number.
So
as
Gautam,
far as we are concerned,
Gautam, just to complete that point, this is exactly what I was trying to ask Samir Arora, who was with us a couple of minutes back, that as this shift plays out from capex back to consumer stocks, what sort of a multiple re-rating and a multiple expansion would you expect from where these stocks are? I mean, let's say if you're talking staples from the mid 50s or so, can they go back to 75 plus 80 times forward earnings? Where would you expect the maximum delta in multiple expansion? Durables, jewelry stocks, staples, travel and tourism, hotel stocks, where will it come?
So, Surabhi, it's very difficult to pinpoint a number specifically because consumption, again, is a very, very diverse ocean, right? There definitely is going to be some re-rating in staple companies because that is where the maximum de-rating has happened in the last 4 years. If you look back at the multiple of Hindustan Unilever, I'm just taking that as a representative because it's a bellwether consumer stock for staples. The multiple used to hover around 70 times in 2020. Now it is somewhere close to 48-50 times.
Exactly.
So can there be some re-rating there? Definitely. But the number delta, and I think the earnings delta is far more important than just the valuation multiple delta. And I think that delta will play out more in non-staple stock. So see, look, the total bounty is 1 lakh crore. Some of that will definitely get saved. There are various estimates, 20-30%. And some of it will definitely be used to deleverage the household income balance sheets. because that's where we've seen some strain in the last 2 years. So then if you work out the number, you roughly reach a number of 50-60,000 crores, which is left for consumption. Of course, it will have some multiplier effect and all, but that will take longer time to play out. In the interim, you will see discretionaries benefiting much faster, much in a much bigger quantum than just pure staples, because the category of the taxpayers which is getting this benefit are not bottom of the pyramid, absolute bottom of the pyramid, they're middle class, right? Where the staples had not gone down completely in terms of consumption. The staples decline that you have seen over the last 3-4 years was manifested more in very low income households. So we think retail, some bit of auto, consumer durables, jewelry, hotels, those are the companies where you might see probably slightly better, performance. And that's why in our model portfolio, we're still underweight on staples. Maybe we will also realign a little bit of a weight within the consumption pack. But at the moment, we are heavily overweight on discretionary or staples.
Yeah, got it. It's pretty much in sync with what Samir also just told us, that the discretionary consumption, that's where the bigger boost will come.
And Trent has provided a good entry opportunity, right, Gautam, as per y'all?
Yeah, I mean, see, Trent has had a very fabulous last 3-4 years in terms of both earnings and stock price performance. I remember in April 2022, when we upgraded the stock at 1,200 rupees, the valuations were not cheap. And since then, they've become even more expensive. As you rightly said, the stock has corrected somewhere close to 25-30%, which is, by the way, broadly in line with what most of the other discretionary stocks have also corrected recently. But the earnings growth in Trent is at least 2x to 3x of rest of the peers in the same segment, both on top line and bottom line. And top line delta is far, far bigger, because in bottom line, you can still manage margin, play around with the cost. But top line being 30-40% versus 15% or 10% of the rest of the companies in the same category essentially means that your execution on the ground is far, far superior to your contemporaries. So I think, therefore, they get that multiple that they're getting right now. And we think the growth can continue for a couple of more years because all their subsegments are firing very well.
Gautam, also wanted to ask you about a couple of other names. One stock that was notably strong, which had corrected, getting to the budget, was Angel One. That stock, I think, on budget day was up close to around 5% or thereabouts. From the capital marketplace, that's your top bet?
Yes, along with a few other names, Nigel, as you said, we right now we have a very vast coverage on capital market. We cover every single listed capital market play. So our bets are on BSE, Angel, and HDFC AMC. Basically, we are trying to play the whole spectrum of the capital market story out there through exchange, through asset management company, as well as a broker. Now, to particular point, in Angel, stock is down somewhere about 35% from the top of last year's January 2024 price. Multiples have also corrected. There have been a lot of changes in regulations that we are all aware of. There is roughly a 20% impact on their earnings, but the stock has corrected 35-40%. And therefore, the multiples as we speak now are somewhere closer to 15-16 times with ROEs upwards of 25%. It's a very pure play, digital market play. So we continue to like the name and we still have it in our model portfolio.
Right, no, absolutely. Gautam, if infra has to derate and consumption has to re-rate, right? First of all, do you think it will happen? It's going to be painful, isn't it, for portfolios? Because point is, as they say, if you have to panic and sell, you must sell early. Stocks are already down. Now everyone is waiting for, let's hold, we'll see, it'll come back. And now this government is saying focus on consumption, not on infra in terms of spending. So it'll be a tricky and painful for portfolios, for money managers, isn't it?
Yeah, absolutely. It's not going to be easy. You don't just wake up one day and change 20% of your portfolio. Because for all said and done, consumption is somewhere close to 15% of the portfolios and industrial somewhere about 5-6%. I'm talking about a very broad top-down level. Of course, individual portfolios are very different weights. So you don't just wake up in the morning and change 20% of your portfolio. It's going to take some time. And it's, of course, going to be painful because everyone else is trying to do the same thing. So, right, if you were lucky and you would realign your portfolio a few months back, that's a very different thing. But what has happened, Prashant, also is a lot of time the portfolio changes also involve a non-tangible element. Like, you play on the psychology because when most of your peers are going to do that, And you're also thinking that has the government changed this view just for 1 year, or is this going to continue for next 2-3 years again? If that were the case, then of course the capex multiples will take a long time to re-rate back to the levels where they were trading at till about 6 months back. So therefore, it's a call you have to make that do you sell into the bonds, which will definitely happen at some point of time, because if you look at the data, the December month capex data of government is very strong. If that continues for Jan, Feb, March, and if there is some rebound in stocks, possible that a lot of realignment again can happen into that strength. But that's like speaking in terms of too short term of behavior. Broader point is if the government is changing its focus, I'm not saying that they're defocusing on capex, but the 30% growth that we have seen for FY21 to 24 is now veering around to 10-12%. And of course, there is an element of execution as well.
Sure.
You cannot just look at more and more because the underlying state governments, the rest of the government apparatus has to also be able to spend and execute on that.
Absolutely. And they're waiting for the private sector to do it as well. Sorry, Gautam, we're very short on time. 10 seconds. Top 3 consumer discretionary stocks that you would have a buy on. Top 3 consumer discretionary stocks. Just the names.
So we've just spoken about it. Actually, it's Trent, Indian Hotel,
Indian
and
Hotels.
Titan. Yeah.
And sorry, the third one?
Titan. So all 3 are part of our model portfolio just from a point of view of disclosures.
All right, Gautam, thank you very much for joining us. Great speaking with you. It'll be interesting to track this and how it plays out over the next many weeks, and we'll come back to you. We take a